Afternoon. I thought I should just give you a bit of background as to my take on things and where I'm coming from, because I work in the financial institutions arena, and so what I'm seeing tends to be the high value, low frequency claims. So I'm educated at Aon from that perspective and seeing claims there. But within our financial institutions practice, we have a number of insurance companies where what we do is we place the professional indemnity and D&O and fidelity policies for insurance companies. So I'm also involved with a number of risk managers of insurance companies who are looking at a number of them Section 166 investigations into their claims operations and things like that. So hopefully seeing a bit of both sides, but hand on heart, I have to say the low value, high frequency losses are not normally my bag. I've spoken to a number of risk managers and insurance buyer contacts about this area for a number of years, and it's somewhere where when we're talking to clients as a broker, when you're trying to get them to either buy insurance or to move their program to the London market, the subscription market always comes up. Now we will, as normal, sell the subscription market and the many benefits of that, and I won't run through those, but almost invariably one of the questions that comes back is, well, what about the downsides of the subscription market? What about the problems? What about the issues? What about all these things we hear? So let's look at those. And I'm going to start with an example. This is a home insurance claim that my wife and I made a couple of years ago now. Consumer lines, obviously. So 24 hours after we notified it, we get a confirmation of receipt of your notification letter. We get a pack that says the service standards, the claims handling process, which claims handler will be dealing with it, their direct line and email details, what their complaint system is, who this guy's boss is if I don't like what he's doing. It tells me that I can go to the Financial Ombudsman Service if I really don't like what they're doing. And 3 days later, I get a second letter which actually gives me first views on coverage. I don't want to talk about whether coverage is actually decided early enough in the London market. I think that's a separate issue. I think the problem, if we have one, is on process. So coverage determination, 48 hours later we had a check. 7 days later I had a service standards questionnaire. So what's the response? Well, I'm very happy. We renewed with the same syndicate. We're very loyal to them, and we've been telling our friends about them. On exactly the same day, at work, we notified a financial institution loss valued at 225 million. Despite chasing, we heard nothing from the lead insurer for 4 months. When we did, we got a reservation of rights and solicitor's appointment. We eventually heard from those lawyers another 4 months later, with a reservation of rights and the first indication directly to the risk manager that effectively he personally was being investigated for moral hazard and not providing adequate or sufficient information pre-inception of the policy. Coverage was determined, took some time longer than the home one, but that's inevitable in long-tail business. 65 days until the whole market had paid. In defence, all but 2 carriers had paid within a week. So 2 people, 2 carriers on about 16 markets across the programme had let people down. And the result, well, that insured removed that lead insurer from their programmes globally, P&C and everything. They actually decided not to come to London anymore and buy their programme out the US. And because we'd placed it, then lost the business at Aon, they then actually reappointed Aon to handle the claim in the next renewal. So there was a silver lining. I think it's an example because one of the questions is there really a problem? And this, you can't properly see it, is the coverage response, the 4-month coverage response. At the bottom there, 225 million claim, about 10 million of premium gone into the market, 4 months after notification, there's the coverage response to the insured. ROR, refer to law firm. That is the first thing the risk manager got back. Each month, this is 4 months after notification, he's had to sit in front of his board and say, what's happening on the claim, to give an update. He's had nothing to give yet. And what's the board response? Who picked these insurers? Should we be suing them? Why did we pay them? Does this product work? What the hell's going on? And is this risk manager up to the job? I'm dealing with 2 risk managers of financial institutions at the moment making large claims, both of whom have effectively been told that if their policy doesn't respond to the loss, they're out of a job. It's not unusual. It's a lot of pressure on a risk manager. So what do the insureds want? And I'm sticking very much to the bullets. They want their claims covered and they want them paid. Now, they want their valid claims covered and they want them paid. But what they really want is certainty. If I sit down with a risk manager and his board or his GC or his finance director and we're talking about an insurance situation, then they will tell me innumerable times that if it's going to be declined, if there's a problem with coverage, they need to know that now. They need to know what to tell the auditors. They need to know what to tell the internal management systems to correct things. They need to know whether the insurance is going to work for them, whether they need to buy more. And waiting 18 months, 2 years to get a maybe, or we're not sure, is not good enough for them. They're after certainty. What do they want from their insurers? They want responsiveness. They want accessibility. They want to see the people who are deciding on their claims. They don't want any surprises. And I'd say that goes both ways. From an insured to insurers, the last thing an insurer wants is a surprise. The updates and the information flow needs to go both ways. They want professionalism and they want support. One of the areas that I think the insurance market doesn't really shine a light on itself is when you're dealing with claims in an area where you have multiple claims. So the classic example at the moment is the Madoff losses. We have a number of insureds around the world with placements in the London market claiming on various insurance policies on Madoff. Now, that one client and his law firm is learning a lot about the claims, a lot about Madoff. We as a broker have 3 or 4 of those and are seeing 3 or 4 different views on the legal advice and the development of the Madoff claims and the insurance angle of it. Insurers are probably seeing, with half a dozen brokers bringing business to them, 10, a dozen, 15 Madoff issues. But when we sit down with insurers and say, well, what are you guys learning about how, as a block, these claims are being handled and how they're developing? What are you learning that you can help us as an insured? How can you educate us? What tactically works? What other arguments have succeeded in other claims? Nothing. No help. I think it's an area where the London market really could differentiate itself. Mutual trust has to be mutual. If you've elected to purchase an insurance policy in the London market and put the premium in, then the trust at the outset is great. Let's not let the trust break down on a claim. And prompt payment. Again, not going to talk about how long it decides to cover at this stage, but once it's decided to cover, pay promptly. And unfortunately, if 14 insurers pay within a week and 2 take 6 months, then the insured remembers the 2 took 6 months and remembers that it didn't work. So somebody else's poor performance actually reflects on everybody else in a subscription market. Reconciling excellent customer service with efficient and cost-effective claims management was the question. So my question is, do we need to reconcile that? Why are they different? Can we not have efficient, cost-effective claims management that is giving excellent customer service? Where do we see the problems? Both on 166 is into consumer lines and through my FI clients. Outsourcing of claims is a problem. This is a problem where it's not managed properly, where the service level agreements aren't met and audits aren't followed through. There are some outsourcing arrangements that are excellent and work, and some insurers manage their outsourcing very, very well. But if you talk to the guys there, then they have a good system to oversight, control, review, analyse, audit what's going on. In the FI world, XCS provide an excellent service to the market on FI business, and a number of syndicates are using them in that capacity. Resource the team sufficiently. Again, when you talk to different claims handlers around the market, it's very variable how many claims they might be handling in a different area. So in a financial institution area, I've talked to insurers where the claims guys are handling 50, 60 big claims. And I've also talked to claims handlers where they're expected to handle over 1,000. You cannot provide a good, timely, proper service if you're handling too many claims, however good you are. Modern efficient systems internally. The market is a bit backward in its systems. ECF has come through very well, I think, has created its issues, but they've been solved. But a lot of people are still secondary and triple keying. If I go down and sit with an insurer to talk about a claim, and they're in front of their system, often they'll have 2 or 3 screens, and they've got to enter it into the ECF system, they've got to enter it into their internal claims system, they've got to enter it into the finance system, and there might even be a spreadsheet for the business unit that, for them, is the underwriting area it comes from. And that's inefficient, and that is solvable. Internal SLAs, get them in place, and increasingly, external service level agreements are being asked for by buyers, and as brokers we're trying to put them in the terms of business as well. And make sure that your internal and your external service level agreements match up, because your external service level agreements with your buyers will be looked at. And in the same vein, don't let the underwriters agree a service level agreement that actually isn't meetable on your systems and processes and doesn't match up with your internal claims ones. Follow it through. Get your management information out of your claims. Get it up to board level. Follow it through. See what happens. See how it works. Follow through on any problems. Employ competent, well-trained staff. There are some really, really good claims staff in the London market. Unfortunately, there are some pretty poor ones. And as I said before, some of the really good ones don't really have as much time as they really need to dedicate to some of the claims. I think that's where segmentation will really come in. Ensure ongoing testing and development of your staff. This is a big thing in consumer lines if you're working on anything with the FSA involved in you. They're endlessly talking about the training and competency schemes. What's there? Do they work? Are they in place? Are they enforced? Are they audited? How do you make it cost effective? Take a long-term view. What is cost effective in claims? What is the best way to manage a claim? The long-term view has to be, in my view, to keep the insured as a client. If you're going to be paying the occasional loss, that's what you're there for. And it's not on the slide, but if you're not making a profit on that line of business, then you're not pricing it properly. If you paid a claim, you've just proven your product works. invest in the staff, systems and the training, segment, find out what can be done manually, what needs to be done electronically, and monitor those costs. And I would also say, I think this is quite an important one, listen to the staff feedback. The guys on the floor handling the claims, the guys who are in front of ECF, the guys that are seeing the brokers come in, they actually know where the inefficiencies are in your systems. They know where they're triple and double keying. There's a lot of information there. There may not be solutions yet, but until you've gathered that, it's very difficult to know how to improve it. Cheapest solution, not always the best solution. That's something I'm told regularly at home. How does the market dispel false perceptions of claims inefficiency? And there's a quote up there. The average PI claim in the London market takes 2.5 to 3 years. That's not a good statistic. And it's taken directly from a US market, Marketing Against London. And it ignores the facts. It's long-tail business. If we look at notification to payment, perhaps it is 2.5, 3 years. But as an insured, as a market, you can't make a claim proceed any quicker than that third party is willing to pursue it against the insured. So are we measuring the right thing? Certainly that's a very good statistic if you're sat in America and Marketing Against London. I actually know where it comes from. I tried to find out from their slides where it had come from. So I don't even know if it's right, but it's certainly what they've been saying. If you measure the time from decision to payment, that would be more important. If you met the time from actually finding out what the liability of the insured was till the indemnity being provided, that would be more important than something that's notified as a circumstance 2.5 years ago eventually because it's suddenly developed being looked at now. Are there inefficiencies? Yes, there are. There is inefficiencies in any market and we can always improve. But if we're being marketed against, let's actually look and see if they are false. The communication side of things, very, very important. What's going on, what's happening, how's it working, and telling your clients how it will work. No surprises. If it's going to take you 6 months, tell them. If it's going to take you a year, if you need to wait for a foreign judgment, tell them. A strong lead. As a broker, we try and pick a strong lead. One of the factors we take into account is the strength of the claims team. We factor that in when we're picking a lead market. And that is, it's not a lead insurer who's going to pay all the claims that we bring in. That would be nice. We're not going to get it. It's a lead who's willing to take a stand, who the follow market respects, who's going to be followed, and who manages their external counsel rather than outsources to external counsel. The lead needs to build their relationships with the follow market. I think this is even more important these days as things do move electronic. Those trust relationships are important. Do I know the guy over at another syndicate who's deciding effectively on my line under the new claims scheme? Do I trust him? How much am I going to second guess him? You need to know if he's any good. You need to know if you trust him. Get out there, meet him. Go to the half moon. Follow and trust your lead. If you've elected to follow somebody, then you've given up your pen on claims, unless you're second under the Lloyd's claim scheme. You've got a right to second guess them, you've got a right to check them, you've got a right to review what they do, but you've got to ultimately trust them because you've written a slip behind them. And data. Collate it. Let's get it on claims. There's not much data in the market on claims that's actually used properly, but there's a huge amount of data that's not used. What's out there? How can we use it? How can we use it for marketing? We know how much premium goes in the London market. It's difficult to find out how much goes out of the London market in claims payments unless it's for a specific event. That is great marketing. Nearly there. Lack of interaction with end client. Is this an issue when competing internationally was the question. I think it's a key issue. What I've been trying to say all along is that good communications between the insurer, the broker and the insured are vital. Often, as in my head of claims role, when I'm asked to get involved in a problematical claim and you look at it, I'm not using my legal skills. It's a communication issue. Have people understood what's been said? Has what's being said been communicated to everybody who's involved, all the stakeholders? And frankly, is the insurer writing to the insured, and is the broker doing their job? The broker has an important role there. If you outsource your claims handling, manage that. If you're using external lawyers, I would actually say communications tend to get worse when external counsel get involved. You don't have to give anything up, but you have to manage them. And if you want an ongoing long-term relationship with the insured, then you have to manage the relationship very carefully. It's actually been said to me on a claim where we got kind of a strident declinature on a weirdly technical point, which, to be frank, was probably a valid declinature. That I didn't put it in writing myself, said the claims person. I was a bit uncomfortable doing that, so I asked my lawyer to do it. If you're uncomfortable doing it yourself and you've got to ask somebody else to do it, it shouldn't be said. If you want to communicate with an insured, especially in my class, 200, 300 million of cover, sit down with them and explain where you're coming from. As I said, some brokers are better than others. Use the broker. Yes, we're there for the insured, but if you have a claim that's not going right and you don't see us on it, my team has currently about 1,100 claims coming in per year. One of the difficulties is identifying which claims I need to look at, or I need to get one of my lawyers to look at. You guys can also call me up and say, can you just have a look at this one? You need to manage your client's expectations on that one. And yes, you also need to ring me up and say, your insured isn't providing the information we need. That is an issue. There's a management issue of what's expected to present a claim. It's a management issue of the client. So it's something that actually needs to be managed between the underwriter and the broker. There's my summary. It's not just a claims issue. Why is it not just a claims issue? Because in claims, we're dealing with the wordings that were put together at the front end. Often, those wordings are imprecise, they're unclear, they don't work in law. The endorsements don't flag in. They're difficult to navigate. There is this, and I understand the need for it, this marketing spin effectively on a coverage. If it's not quite clear whether it should be covered or not, whether it can be covered or not, let's put wording in that probably covers it. And then when the claim comes in, we can examine that. We cover fines and penalties where not insured by law. Well, does an insured know if he's got cover or not? He wants certainty. His board wants certainty. The risk management team are actually doing gap analysis against BAL event categories and seeing if they've got cover. It's unclear. If you write it out and say it's not covered because you don't think it can be, and another market will come on and say, oh, we can cover that from Bermuda. You do have that issue, but if you're frank with the insured about what will actually work on a policy and get the policy right, actually a lot of the problems on the claims coverage can be solved. Communication, as I've said, all three very important. Communication of the product is also important. Talk about product drafting, and when I work with a consumer line client and they're drafting a policy, then they'll decide that they're going to cover a particular area, a particular class. They're going to come up with cover for, I don't know, my windsurfing equipment. It's probably me that needs cover when I'm windsurfing rather than the equipment, but that's a different point. But they'll decide they want to write the class. So they start looking at the policy, looking at the exposure. Internal, external counsel will get involved, drafting this policy. It's going to be released to lots of buyers. Limit's only going to be 5,000, but that's what we're going to do. We're going to have compliance have a look at it. We're going to have a second pair of legal eyes look at it because it's a big product we're launching into the consumer market. We may even have a product committee look at it before it's approved and released. And then the marketing data, how we're going to sell it, will go through a similar process. On a large commercial placement, the broker and the underwriter will sit down probably 12 hours, 24 hours before the policy incepts and have a discussion about what amendments may or may not be made to the wording. They'll insert some things that look good, they'll make some changes that may or may not change cover, but may actually make the policy less likely to respond. There's no legal review, there's no second part review. So good communications, and as I said, if you get the communication right, actually you can solve a lot of the problems. And if you get it wrong, and ring the insured up with a good relationship and say, I got it wrong, you can often keep the client. Don't end up paying a claim and losing the ongoing premium by claims handling. My red light's up.
David, thank you very much. Thank you very much indeed.